How to answer an exam standard question in 10 easy steps. Step 9. What I want to look at now is part B, the return on capital employed calculation. Now, return on capital employed is typically calculated in this manner. We take the estimated average annual profit and we divide through by the average investment. I suppose I could have multiplied by 100 if I so wish. Now, the first thing I want to highlight to you is this. If we're looking for the estimated average annual profit, I don't want you to go back to the source data we have in the question. Instead, we have to remember that we've done a lot of analysis already, and therefore the number that we're looking at is probably floating around somewhere in the question. If you remember back to the calculation of our operating cash flows, we got a net trading revenue for each year. Now, what we can do is to take this figure as something akin to profit. Okay? So the first thing I'm going to do is to take the net trading revenue numbers that I calculated year on year and add them together to get a total, 530,000. Now, once we've got that, well, what's the difference between net trading revenue and profit? Well, in terms of F9, the only difference is the obvious non-cash flow. And that non-cash flow is depreciation. So if we've got our net trading revenue, we can offset depreciation to get the profit that we need. If you think about it, we bought the asset for 250,000, we sold it for 5,000, that's the plan at least, therefore the total depreciation during that 4 years will be 245,000. That gives us a total profit of 285,000. We divide it by the number of years and hey presto, we've got what we wanted, the estimated average annual profit. So remember what I said here. What we want to do is we want to start with already analysed information if possible. We don't want to go all the way back to the beginning because that will take us a lot of time. Then we want the average investment. Now this is a very simple calculation. It is simply the average, the simple average, of the start and end point. So the start point was 250,000. That's what the asset was worth when we purchased it. The end point is 5,000. That's what the asset is worth when we sell it, dispose of it, add them together, divide by 2. Hey presto, we have our average investment. So we take our estimated average annual profit, we divide through by the average investment, and hey presto, we have a return on capital employed. But remember, the examiner said calculate and comment. So let's make sure we make a comment. Given the target ROCE of 20%, we should accept the project. In simple terms, the ROCE that we've calculated is substantially higher than the target given in the question. So in summary, a key tip here would be to understand where information may already be available from previous parts of the question. What we may already have done when we've been analysing something already.